Ultimately, what we do is we help people become their own bank to recapture the banking functions in their life to build wealth. That's really what we do. We were not taught how money works, but we want our kids to have that knowledge. The cash value, the dividends that come in every year, don't stop. So your policies are compounding on top of themselves uninterrupted for the rest of your life, while keeping the money in the family's control. No credit checks, no banks, no restrictions. That's powerful right there. What we do here at the Money School and BYOB and Chris Naugle is we like to teach and provide knowledge. A lot of what we talk about is around the infinite banking concept, but infinite banking is all around financial knowledge. So having more financial knowledge is what we like to teach in the Wealth Wednesday webinar. I think what 2 weeks ago, I did one on how wealthy families use the infinite banking concept to create generational wealth. But we have a lot of live events. So we have the obviously WTF that was this morning that I did. We also with Michael Podgy, we have this event. We have the Ask Me Anything at 4:30 Eastern time, where we answer questions live around infinite banking, wealth building, that kind of stuff with other team members, colleagues. We have our Monday webinar. We have a Tuesday Take Back Control webinar on infinite banking. So we have a lot of live events. So if this is your first time here, just keep that in mind that we have a lot of other things we do where we share a lot of our knowledge, our experience, and things around infinite banking, that kind of stuff. Okay. Now, by the way, ask questions as we go through this presentation. Feel free to ask questions, use the chat box, use the Q&A box, that kind of stuff. And so what I want to do on this webinar, this presentation, was really take some clients, some people that I personally know, and talk about how people have used infinite banking, what they've accomplished. Because when you first come across infinite banking, it sounds really cool. It sounds awesome. It's amazing. Too good to be true. I hear that quite a bit. But how do you use it? So how have other people used it in their lives? What have they accomplished? What have they done in their own lives? So we've been teaching this concept for many, many, many years. So we have a lot of clients, tens of thousands of clients. And so I definitely want to show you what some people have really done in their lives and go through some, call it case studies. And there's actually somebody here who's on live here that might be able to share. I'm hoping he can. He's actually at the event down in Dallas right now, but I want to have him share what he has done with infinite banking. And by the way, if there's any of my existing clients or our existing clients that are on the call right now that have had, experiences with infinite banking and accomplished certain things that would like to share, please let me know. I can actually have you hop on. If you can unmute yourselves, I can have you share what you have accomplished. Yeah, in Georgia. Yeah, so I'll provide my email and my call link here on this presentation. So if you want to reach out to me, you can do that. So actually, I'll put it in there right now just so you have that link. Sure. So that's my personal call link right there in the chat box there for you. Okay, so this is Shane. Shane's obviously one of our clients. So a couple things, questions, Shane. So kind of give us a quick background on just kind of who you are as a person, age, kind of that kind of stuff.
Yeah, I'm just a normal guy, 48 years old. I got 3 teenage kids, a wonderful wife. Worked for the man for, since about 6 months ago. I've been hanging out around this campfire for about 2.5 years, maybe a little before that, before I actually got my first policy. And just been learning from you guys. Brian's, filled in a lot of the gaps that I've had, which has been great. And it seems like each presenter has a different, mindset, or maybe not mindset, but maybe tolerance for certain things. And, sometimes risk factors, sometimes, how they move their money. And each piece seems to kind of adjust my own principles on what I do. So yeah, I just started using, what you guys do, and got myself out of my W-2 about 6 months ago, and did a case study with Chris a couple months ago or so, which went live a couple weeks ago. And I got my Turo cars, 2 of them so far that are involved with the recapture and repayment right now. And then I also use your PMC platform to find deals, and I've been doing very well there, learning as I go. So if anyone's listening and they're nervous or scared or don't really know where to start, being around the guys is a good start. And then, putting a little money out there is, kick your training wheels off, so to speak, so you can feel good about what you're doing.
Yeah, exactly. So Shane, what was kind of your situation before infinite banking? Like, what were your kind of your challenges, your obstacles, things that were kind of holding you may have felt were holding you back?
The main thing was just my previous experiences with whole life insurance policies. which you guys have kind of unwrapped and exposed, is sometimes the people who set them up for you are making all the money and you are not. And then there's, I've kicked around a few different places and I've, tried to find, the right gut feeling, so to speak, backed up with the numbers. And I hadn't found that till I bumped into you and your team. And that was probably the biggest shift. But once I saw that I could actually get high cash value, which was one of the biggest goals I had, and then once that money was in there, it was compounding interest year over year over year, which I did understand. It makes you wealthy in increments. And with the way that you guys put it together and explain it, I was able to put it into my own life experiences.
Yeah. And so remind me, when was your first policy?
First policy was November 2022.
Gotcha. And what did you use that first policy for?
I used it to get some money on Private Money Club so that I
Okay.
could earn income off of it. So mailbox money, which is, what you guys kind of called it then. And
Right.
then use that mailbox money to basically make me secure enough to buy a second car for Turo. And then once I saw those things worked, then I used the other money that I had in there to refinance out of one of the cars that I did have financed and started practicing the IBC process.
So for those of you who don't know, so Turo is where you can use your own car, go buy a car, and then you put it on Turo and you can rent that car out to other people. So people are coming in for an event, for a holiday, they rent cars from you instead of from a car company. So it's a different way of doing it. But yeah, it's kind of like Airbnb, but for cars. And so how many cars do you have now doing that, Shane?
I got 3 right now. So it was doing well enough. I ended up having a 2020 Honda Pilot that I had leased, and I had purchased that off of lease to make it my third vehicle. That was at the tail end of 23. And, so I ran 3 of them over this past year. And each car's got me, on average, about $1,000 a vehicle and per month. So 3 grand a month or so is what comes in for Turo.
Yep.
And, and I've recaptured 2 vehicle payments now since then. So I was able to take my old 2013 and my old 2011 pilots and recapture those payments. And I'm doing that for 2 reasons. Obviously, it's nice to have the money, but like once I kind of learned, you're just shuffling, in my view, you're shuffling your money around so you get it back and you can reuse it again, which
Mhm.
is basically what the process is. And I've been able to use that money to start to fund my second policy that I started in 23. So
Yep.
I'm starting to get to what you guys are calling self-sufficient on the policies.
Right.
So my structuring of doing a note to myself, which I didn't understand for like a year and a half, to be honest with you. I had no
Yeah.
idea. I'd go and ask me anything, what do I do? And they're like, you just make a note to yourself. It's like, that's cool.
What's
So
that mean?
so I finally did. And, I do a note for myself, Shane Hollingsworth, to my business, which is Quality Home Limited. And I have it feed into my segregated account. So everything's tracked
Okay.
and done properly. So I, hopefully don't get in trouble with the tax guy, which I haven't, but it's been smooth. It's been easy.
And so another question. So before infinite banking, when were you planning on leaving your job?
Shoot. I wanted to leave 4 years ago. I had no plan, for leaving the job, but I had plans to find plan B, plan C, plan D, however many plans it took to get me out.
Yeah.
So I was tired of, corporate type stuff where, what doesn't matter to anybody anymore. And that's what I was running into is I had a wealth, I had a huge toolbox of knowledge. And, it was more of, we really don't care. It doesn't fit our
Right.
room that we've been talking in. And, I'm an older guy, so I guess that could be part of it too. You're a dinosaur now, which I don't know if, that I always thought dinosaurs were older than me. So, but maybe that was the case, they were just over it. I mean, they're nice people, but you know how it is. Sometimes your views just don't align, and I knew mine didn't. I was just tired of things that used to work not being implemented. So we had a worse projected year and, getting paid, on salary basically was never cool.
Right.
I don't know. I'm a hustler. I like to work. I like to help people. I like to earn a few bucks if I help in quantity. You know what I mean? And win-wins is kind of the name of everything for me. And there was no longer a win-win there.
Gotcha. So you left that when you leave that job?
That was October 2024.
And infinite banking obviously accelerated that because of the, putting the money back in the cash flowing assets.
Yeah, I mean, I had to figure out the process, right?
Right.
I had to, have a system that worked. That was probably the big thing. I had to have buy-in too from my wife, and
Yep.
that's a big thing. If you have a good one, you already know they are gonna be the air beneath your wings because you're gonna be spitballing things and ideas. And if they're like not on board, it makes it a lot tougher. But I mean, we had a vision 4 years ago, and it started with me crying on my bed about how much I hate this place.
Job.
And I was frustrated, man, very frustrated with just how everything was going.
Yeah.
And she was like, and we're big believers in, if we pray and give it to God, that it'll come back to you. And it may not be exactly how you think, but stuff will start to kind of take shape. So it
Yeah.
did. We had the Turo that started working great for us. And then we started learning how to recapture the money on that with watching your videos. And then the private money club was another godsend, man. I tell you, they always say not to let your money stay sitting, but
Right.
what do you do with it? So private money club allowed me to do something with it.
Yeah. And for those of you that don't know what Private Money Club is, for those of you who are new, so Private Money Club is something that Chris runs where it's borrowers and lenders coming together to do deals together. So over 5,000 members, over $150 million of money lent out and borrowed. So people like Shane and himself, we go and lend to other investors who are doing typically real estate deals, and you become the private lender. So it's kind of funny. It's actually being the bank again. So the infinite banking strategy, you're being your own bank, but then you can lend money and be the bank again to create cash flow. And that's where you get your money working, for you in two places at the same time. Once in the policy, once also in a private money club. So the one thing to keep in mind, so for those of you that don't understand, infinite banking maybe is kind of first time hearing about it. Infinite banking is just the strategy of using a specially designed dividend paying permanent whole life insurance policy with a mutual insurance company as a way to recapture your money in your control, privatize your money, protect it, and then be able to use that money in more than one spot at the same time. And so I'm going to go through about 8 other case studies of actual clients of ours, just like Shane, and what they've accomplished through the infinite banking strategy. Okay. Then Marcel says, I'm a pro tax advisor, so important to make sure you don't get caught up in tax problems too. Yes. So with infinite banking, so inside the insurance policy, you're earning returns, but those are tax free unless you, for some reason, crazy, take it out permanently. But it grows tax free inside there. Loans are not taxable. Okay, and you're funding it with post tax dollars. But yes, as Marisol says, that once you take the money out, and Shane, you can attest to this, once you take the money out and start lending on it and doing other things, that's where the tax consequences are, because now you're earning money on your money outside of the policy. But yeah, I'm not a tax advisor. This is not strategy, tax advice, of course. But yes, definitely have a good tax person on your team. Very good strategy. So as Shane, you can probably attest to that.
Yeah, I completely agree. If you have the right team in place, you can use this to actually create more write-offs too. And again, talk to your tax people, but LLCs have allowed me to basically, when you're a capitalist or someone who's out there trying to make the world better when it comes to funding deals or whatnot, you have a lot of codes that are out there for you to help you keep more of your money.
Mhm.
And, if you have debt, like with me sending the money to my Turo business to refinance my cars through my own personal policy, that is a debt from me to the company. So when that company pays me, I'm getting my own money back per se, plus a little bit of interest. And the only thing that's really that, most people don't talk about is that, yeah, the interest that you did bring back in technically is something that's taxable. But
Yep.
the Turo side is fantastic because I get to write off my miles, any expense that I have on there. And for me, my three teenagers, they help me clean the cars, they help me deliver the cars, and they allow me to basically fund their lifestyle through that business. So if we have soccer teams or we have, swim or whatever the case is, they can pay for it with the money that they earned. And if they have any own of their own entrepreneurial type things, like I mentioned this on the case study with Chris, my oldest and my youngest started making these little crochet puppets or animals, whatever the
Hmm.
case is, frogs and kind of neat little things. And they went to a school event where you could sell them. And so they made like 250 bucks, but they used their own money that they earned to decide to do something to make a little bit of money. They had fun doing it, and they could see that I spent something and I made this much. So they made a spread on their seed capital. So they're learning a little bit at a time, but it needs to be, they are younger still, they're in high school. So they're learning that, if you put a little bit of effort out there, you can make it work for you. You can have fun doing it. So that's kind of cool.
Absolutely. I love that. That's so cool. So Robert asked a question here from you, Shane. When were you able to leave your W-2 job? I think it was 2023, you said, right?
No, it was October 2024.
Oh, okay, that's recently, yeah.
Yeah. And what's cool is, you can leave, whenever you want, but for me, I wanted to be secure. I have a family, I have a home, I have, certain things that I don't want to lose if I do something, if I screw up, let's be honest, that's the underlining fear factor of doing anything, right? Is what if I mess up? So I wanted to make sure it made enough income coming in so my bills were covered. Obviously, I had to do work on my own budget to know what that was, like real numbers, guys, not the pretend ones like, oh, I spend 500 on groceries. No, it's a grand or it's 2 grand. What's the real
Yeah,
number?
it's a real number.
What am I blowing money on? So you can kind of rein it in a little bit. But I knew those numbers for the last 2 years. And it was kind of ridiculous me still being at work. My attitude was shifting. I was I
I've
was
been
no
there.
longer a star employee. My friends would ask me what's wrong. It's like nothing. Just tired of the stuff of the corporate stuff. But
The grind.
the grind. And I'm actually okay with the grind, to be honest with you, Brian. I just don't like when what you say has no value anymore, even though it's produced like there's a track record of wins.
Yeah.
So that was probably I don't know, is that more of like a disrespect?
Yeah, I get
And
it.
yeah, we're all different. That's just the way I viewed it. And I was
Yeah.
happy to move on.
Yeah, I was in the same place at one point in time in the rat race, corporate America. I didn't like it. People knew I didn't like it, even though I was did well at my job. And that day that I left was pretty amazing. So Marisol asked a question about, can you make a big deposit at once? Yes, you can. So it's called a lump sum dumping is what we call it. But yeah, you can do a large amount in up front to then turn around and reuse it really quick within 30 days. I mean, so you can be using this thing within 30 days. Absolutely. Conrad, how much do you need to start? I mean, it depends on every individual's different. I mean, the minimum just to start is 10 times your age per month. So just add a zero to your age. That's typically where you can get started, but it's going to depend upon your situation, your financials, your cash flow. Donna, yes, it can pay for kids' college. Actually, I have a case study that I'm going to go through on exactly that. Exactly that. So for sure. So Shay, I'm going to jump into these ones. Any last comments or advice for anybody?
Comments or advice? I mean, yeah, comment is just reach out to them. What I did learn is I didn't sign up, right away. I called and talked to someone just like Brian within the team. And, the guy I was talking with, we kind of did a couple things where we figured out, what kind of cash flow I actually had that was, available, like stuff you'd put in your savings account.
Right.
Where's that? I I also, knew that number and I knew it was comfortable for me. So, the dump in it, someone asked about the dump in. I put a large dump in and my policy is making me money year 3 on like between dividends and interest. And that is a money tree as you might hear from some of the guys on the later show today, Ask Me Anything. And call Brian, reach out to him. I've learned, I tell you, I think I've learned, like I had so many moments when I started to attend today's webinars and the Tuesday, Take Back Control Tuesdays from Brian. And again, it was just he explained it, just there was a nuance in there that was different than how the other guys went over it, and it resonated with me. So kudos to you, Brian, because I mean, I
Yeah.
was just like, whoa,
Yeah.
amazing.
No, I appreciate that.
Um,
Yeah. I think my first webinar I ever did on infinite banking was back in 2016. So
wow.
it's been a while. I've been doing it, the presentations for a while. So and then my mentor in infinite banking was actually someone that was taught infinite banking by one of Robert Kiyosaki's guys. So he was an advisor to Robert Kiyosaki. And so I know a lot of his advisors, but yeah, one of my mentors has done policies for that guy. So yeah, that was a long time ago. But well, Shane, I really appreciate you being here. Appreciate all the input, the kind words, that kind of stuff. So
Yeah, you're very welcome. Thanks for having me. I do
yep,
appreciate it, Brian.
absolutely, man. We'll go enjoy the event.
Will do. I'll go say hi to Chris again.
Right in. All right, take care.
All right, take care.
All right, everybody. So some quick questions come in before I jump into these other case studies. Let's see here. So yes, Ida says you have to make sure it is not a mech. Yeah, we don't build mech policies. Absolutely. Yeah, we don't do those. And Margaret just said she paid off her time server with her new policy. I love that. That's awesome. Yeah, John Thompson is you make your deposit into two separate accounts, one under the LLC, the other for the IRS. Yeah, that's a good way to do it. And then we have some financial advisors that do work with our clients, that kind of stuff. Marcel says it's a whole life specially designed, That's the key word, a whole life policy. And it's not term insurance. Yeah, it's not term insurance. We don't do that. Yeah, you may have to spread the payments over years depending on the money. Yeah, it depends. I mean, we have some people that do dump-ins with premiums. Some people just do premium deposits. That's it. And then Sherry, if you have no savings, then you've got to sort of look at your cash flow. You've got to look at where your money's coming in and where it's going. And that's kind of what we help each other with. This fell down over there. Yeah, no, that on a call, we would help you do that. And yes, Marcel. So you saw my call link. I put it in there above. If you want to just hop on a call with me, I can go through what a policy would look like and how it was funded. So, but yeah, keep the questions coming in, guys. If you guys have seen me on these presentations, I answer questions live as I go through the presentations at the same time. How often can you withdraw from your policy? Monthly. We've had people do it more than that, but depends on how you're using it and what's inside of it, Melissa. But yeah, so we have people that are borrowing every month. Some people borrow them every quarter. Depends on what you're doing with the money and what you're trying to accomplish with it. But that's a big thing with infinite banking, is really understanding not the policy per se itself, but really what are you trying to accomplish? What are we trying to solve? Like that's the first question you have to answer. What are we solving? What are we accomplishing? Once you understand that, then you can look at, okay, now how's the policy going to help you do that? Okay. All right, let me go ahead and share my screen here real quick and let's dive into it. Oh, I just lost the chat box. There it is. I'm not sure what you mean by letter, John, a certain letter that should be correspondent to the clause of the licensure. I'm not sure what you mean by that. Yeah, JB, yeah, definitely come back. I mean, this is just the tip of the iceberg, to be honest, when it comes to what we do and how we help people. So yeah, this is just the tip of the iceberg. So what I want to do right now, real quick, is I want to share some case studies around infinite banking. And so keep the questions coming in. If you can, use the Q&A box too, so that I don't miss that. But yeah, let's go through these things. Conrad, credit really doesn't matter for infinite banking, except depending on why you have bad credit. So they don't want you to have anything in collections not being paid on. Like that's the big thing. If you're not in collections, but just have some bad credit, that's fine. So yeah. Carol, so is this program webinar about how to use your money in life insurance? Yes and no. So we cover lots of topics on the Wealth Wednesday webinar, but ultimately what we do is we help people become their own bank to recapture the banking functions in their life to build wealth. That's really what we do. Okay, so here's some case studies. So these are some different ways that people or clients or acquaintances have used this one. So this is a business owner. So he bought equipment without using bank loans. So if you understand how infinite banking came to be, and if you ever have read, the Nelson Nash's book right here, Becoming Your Own Banker, what Nelson used a lot of his policies for was buying equipment. So that's one of the main things that he used it for in his own life. So this is Mike. Now I've changed the names inside of these so that keeping them confidential. So Mike owned a mid-sized construction company in the Midwest, doing about 1.2 million of revenue per year. So he has quite a bit of revenue coming through. And his concern as a business owner was he wanted to avoid traditional banks and bank loans and keep cash flowing strong through the growth phases. Because when you're growing your business, your cash can be kind of lumpy. It comes in, it goes down, it's high, it's low. I've owned businesses before, and it can be kind of stressful. Okay. So a lot of business owners use like a bank line of credit to even out their cash flow, but then you're paying interest to a bank. Okay. So the problem, so he needed to buy some new equipment. So for him, it was an excavator and a service truck for his construction equipment or business. The total cost was $120,000. Okay. And so he knew he had to buy this stuff. Now he knew he had to buy it ahead of time. Like we're talking like, 2 to 3 years, because when you're in business like this, especially construction, by the way, you know that you're going to have to buy equipment. So I used to be in construction, by the way, so I understand this one. And so you have to kind of think ahead of time. Okay, in 3 years, I'm going to have to buy this. In 2 years, I'm going to have to replace this truck. You got to think ahead. And so he knew that his bank was going to be offering financing at 8% over 5 years. But it required heavy documentation, it required collateral, and it would also lien the business assets. So that's one of the things when you want to get financing for a business, it requires a lot. And I've had to do this before to the tune of $500,000. You have to give personal guarantees as well, which means that yes, your bank is financing the equipment for your business, but you are personally on the hook if your business doesn't pay it off or the business goes away. You still personally have to pay that back if you haven't built what's called business credit. So what he wanted, though, he wanted faster access to funds. So he didn't want to have to go through the 30, 60-day process with the bank. He wanted more control of the financing, because when you have a bank loan, do you have to make a payment? Well, yes, absolutely. If you don't make a payment, they're going to come take the equipment. So he wanted more control and a way to keep interest on his money while using it at the same time. Okay. So he came across infinite banking. So the initial setup was this. So it was 3 years prior. So remember, he was thinking 3 years ahead of time, and he knew that he was like, man, I don't want to finance it with a bank loan. So he came across infinite banking and said, well, wait a second, I can do this and also fund the equipment. That's awesome. So he did an annual premium of $50,000. So he's putting in $50,000 per year. Now, keep in mind that for some people, that might be a large number, but his business was really funding that. Okay. So some people are only putting in $5,000 per year. It just depends on you, but he put in $50,000, of which around $35,000 to sometimes $40,000 of that is going to go to what's called paid up additions, called PUAs. So inside these specially designed, that's keyword right there, guys, specially designed whole life policies that we build, we have PUAs. PUAs rapidly build the cash value. Okay. So by year 3, his cash value is $135,000 already. And it's going to keep growing to the point where he's going to have significantly more cash value in the policy than he's put into it. So his borrowing power is going to get greater and greater, because when he borrows from the policy, the cash value, the dividends that come in every year, mutual insurance company, don't stop. So your policies are compounded on top of themselves, uninterrupted for the rest of your life. That's powerful right there. Okay. Okay. So that's what he did. So he started a policy 3 years down the road, had 135,000. So someone just asked, can you use a HELOC? I have a good credit union you use. Yeah, you can use a HELOC to fund a policy if you understand velocity banking. So yes, you can. Okay. So this is what Mike did. All right. So the actions taken. So he took a policy loan of $120,000. So that's a guaranteed loan. It's a private loan, does not go on his credit report, and it's guaranteed. There's no qualifications. He gets his money within a matter of, days, sometimes the same day, but typically a couple days. Yeah, Marcel, you do velocity real estate. I love that. Okay, so he bought the equipment with cash. So now the cool thing is, when he paid cash for the equipment, who owns the equipment? He does. He has title because he paid cash. And can you negotiate with cash? Yes, you can. You can negotiate when you have cash versus a bank loan. More negotiation, I guess, the room to move on the price. So he bought the equipment. Now he owns the equipment. Okay. The insurance company, their rate is around 5% simple interest. Okay. But even though he borrowed 125, his policy is still earning dividends on the full $135,000. So he has not interrupted the growth of his money. And then he chooses how he wants to restructure his payment. So when you borrow from the policy, there is no required loan, as most of you know, if you've been around us a while. There's no loan required on that $120,000. But should he pay it back? Well, yes, of course. You want to be a responsible banker. So he's paying $2,300 a month back to his own policy, back to himself. Okay, just like a lease to own. So that's what he's doing. So tax implications. So somebody mentioned taxes. Okay, so the policy loans are not taxable income. Excuse me. So there's no tax there. Okay. Mike was also able to write off the equipment purchase as a business expense, and there's also depreciation. and kept the interest payments inside of his own system, inside his own banking system. So what are the results of him doing this on this purchase? Okay. So he avoided $24,000 in interest payments to the bank. So he didn't pay that out. He retained full control of his repayment schedule. So if he had a light month where maybe he didn't have any cash flow, guess what? He doesn't have to make that $2,400 payment back to his own banking system. He doesn't have to make it. So he has more control. The equipment was fully owned up front. So as I said, better vendor pricing and no liens on that equipment. He can resell it. He can do whatever he wants. It's his equipment. His policy grew as if the cash value, full value, was untouched. Okay. But guess what? This is an internal financing model. As he pays back his policy, okay, as he's paying that back, the amount that he can borrow whenever he wants goes up. As he puts in additional premiums every year, 50,000, the cash value goes up. At the end of every policy year, as dividends come in, they add the cash value goes up. So he's able to then start faster, or not faster, but more quickly, he can repeat that model for future things. So trucks, trailers, tools, he is now financing his entire business through his policy. And as time goes on, more and more is available, more and more he can finance. Okay, so this is just a quick example. So does that make sense? Keep in mind, it was not like instantaneous. He took him 3 years to do that, but he had the foresight. Now, if he'd had $100,000, could he have dumped 100 grand into the policy and as well the 50,000 upfront? Yes, he could have. And he would have had access to about 125,000 within 30 days if he'd funded it that way, but then the policy would have kept growing. So there's lots of ways to do this, okay? All right. So that's the business owner. That's Mike, how he did his equipment without any bank loans. All right. So now let's look at this one. This one is really cool. Now, if you have ever gone to college, if you've ever had kids who are going to go to college, this one's going to be pretty cool. So how many years can you fund the policy? Depends on the company, but minimum 7 to 10 years is what we recommend. But I mean, you can fund them for longer than that. There's some companies where you can fund it for your entire life. Yeah. Can we keep it for more? Yeah, absolutely. Absolutely. Yeah. Yeah. And especially when they're younger, when you're younger, you want to be able to fund it for a long time. So some of them are like 30 years, some are 20 years, some are, some people only do it for 10, but yeah, a lot of them can go for a long time, a long time. Someone says, if you pay 500 each month, can you pay more the next month? Not really, no. It depends on how you build the policy, anonymous person. This says anonymous attendee. So you typically can't put in more than the policy is built to allow to go in. So that reasoning is why people do more than one policy, okay? You can do more than one policy. So once you have one policy working for you, and maybe you have more income now because maybe you paid off some debts or you invested it, do a second policy, put more into it. So there you go. That's how you can do it. All right. So this is how a family uses a policy to pay for their kids' college education. So once again, I changed their names. But Sarah and Jason in suburban Colorado, dual income household. So they're making about 180,000 per year, teacher and an engineer. And they have 2 kids. They have Emily, who is 17, and Luke, who is 15. And so they were some of our clients. We coached them through this process. But their big concern was that they wanted to avoid massive student loan debt. They didn't want to be tied to the government, you know, like Stafford loans, things like that. But they wanted flexibility if the kids chose a different path. Now, this one is so freaking important to me right there. What if your kids don't want to go to college and you've been funding a 529, right? Okay. But what if they want to go do something else? What if they want to go into the trades, you know, be a journeyman or something like that, or an electrician or whatever, right? All of a sudden the 529 does not apply. Okay. So that was the big concern. Marisol, you need a social security number, or you need to have a ITIN number. Yes, you have to have that because the insured is going to be you, a human body. Okay. You can have an entity own the policy or a trust own the policy, but you have to have a social security number or an ITIN number. Yeah, definitely. And it's not universal life. By the way, I have personal experience with universal life. No, this is what's called dividend paying permanent whole life for infinite banking specifically. Not IULs, not ULs, nothing like that. This is especially for infinite banking. So yeah, good question though. Good question. One sec. So Chris Naugle just actually texted me. There we go. All right. So here's the problem. So with this family, okay. So by the way, Sam says, where's the Nagmeister, Steve and Nagy? So they're at the live event down in Dallas right now, all of them. So yeah, so they're down there right now. So here's the problem. So with college tuition rising fast and volatility in the markets, right? So Sarah and Jason, they were thinking about 529 plans, but they were very uncomfortable with them because It felt like an IRA, a 401k, which by the way, it is. I mean, that's what it is. But they also didn't like how you had no control over the funds. So think of that. You don't really have full control of the funds. There's tax penalties if the kids don't attend college. Yeah, 529 sucks. Yeah, if they don't attend college, you might have tax penalties all of a sudden. The funds are exposed to market downturns right when they need it. So let's say you're paying for college and the market takes a downturn. All of a sudden you're losing money because the market's going down. You have less to take out of the 529 and you're taking money out of it. So it's accelerating the actual fall of the 529. Okay. So they wanted a solution that kept their money growing safely, flexibility if the kids chose a different path in life, which can happen. And then they really didn't want to saddle their kids or themselves with debt that they didn't control, debts that, could come back and haunt them. So, because keep these in mind that, if you don't pay these things, they can come after you. So that was some of the things that they really did not, didn't want to have. So here's what they did. Here's what we did for them. So 5 years prior. So keep in mind, this was 5 years, and I was giving you kind of the snaps of where they are today. Okay. So Jason, so the husband, started a high cash value called a HEC-V. That's what we build on himself. He was going to put in $30,000 a year. So around 22,000 of that was going to go towards paid PUAs or paid up additions. After 5 years, they built up $115,000. Okay. Now, what I want you to understand here is they were doing this because they were going to send their kids to college, but they also wanted to fund this stuff for themselves down the road, so they could actually start building wealth in like real estate. So they were taking about $30,000, putting it into here. Now, the question some of you might ask is, well, Brian, where did the $30,000 come from? Okay. Well, they were actually funding things like they were going to go fund a 529. They were going to fund a 401k. They were doing that, or an IRA. So they took money that was going into this bucket over here and moved it to the infinite banking bucket. So their cash flow really didn't change all that much. Keep that in mind. Okay. So step 2, college time. Okay. So when college came around for Emily, State University, the out of pocket for 1 year was $28,000. Okay. So, and that's staggering because, man, when I went to college, it was a lot cheaper, but still expensive. That's amazing how much it is right now. So instead of loans, Sarah and Jason took a policy loan out from their own policies to pay for tuition and dorm costs. Okay. So that was about a 5% loan right there, right? That they took out. And then they structured voluntary, because they don't have to make the payments, repayments at $25,100 per month for 12 months. So they were going to pay the loans back themselves. Okay. Now, there's other ways you can do it, by the way, where you can actually have your kids pay the loans back after college. So maybe they don't pay the loans back day one. Okay. You don't pay anything back. Interest accumulates. After they graduate, they get their first job. Then you have your kids pay back the policy loans. Like, that's another way to do it, by the way. And I have clients that are doing that too. Okay. So step 3. Now the same strategy is planned for Luke in 2 years for the other kid. Okay. And they're going to be reusing the same policy for both kids by managing the repayments between the kids' schooling years. So they're going to replenish the cash value, take it back out to pay for college, replenish it, and do the same thing. So back and forth. But here's the thing. The policy is still growing. It's not going down in value per se. It's actually growing in value over time. Okay. Now, I didn't even talk about the death benefits with these policies. There is a death benefit that is also growing over time to create tax-free, guaranteed generational wealth down the road. Okay. So these things are doing a lot of things at the same time. Once again, I'm focusing on the case studies. If you guys want the full video about infinite banking, obviously reach out to me and I'll send you that. Okay. So here's the results. So 1, they avoided taking out it's called the Parent Plus loan, I think is what that one's called. That's what I don't know much about that Parent Plus loan, or tapping into home equity, because that was the other way they were going to pay for the tuition, was by getting a HELOC and then using that, which they wanted to avoid. They had complete control over the funds, so no FAFSA restrictions, all that kind of stuff. The policy continued to earn compound dividends and interest on that cash value, even though they had borrowed against it. Once again, that's one of the key things about infinite banking. And then if Emily didn't finish college, which I don't know if she did or not, because we're not that far along yet, they could redirect the money with no penalties. So let's say that she doesn't go to college. Guess what? What she want to do? Oh, I want to go into trade schools. Okay, we'll fund that with the policy. Hey, I want to do real estate. I want to become an investor and not have a W-2 job. Okay, we'll use that to fund that. Okay, all that kind of stuff. But the other cool thing here is this, is when the parents, when they went through this concept of learning how infinite banking works, they realized that, guess what? We were not taught this stuff when we were kids. We were not taught how money works, but we want our kids to have that knowledge. So what did they do? Well, they actually are teaching their kids how infinite banking works so that, hey, guess what? When they go to get their first job, they might say, no, thank you to a 401k, and we'll do infinite banking instead. By the way, I have a client, he's 19 years old, going to college, and that's exactly what he's doing. His policy is going live, I think, next week. He goes, I don't ever want to use a 401k. He goes, I want to do this. So kind of cool to see that. But yeah, they're going to teach them how to use their money themselves, maintain control of it, and create that generational knowledge and generational wealth. So a lot of cool things this family is doing. Okay. Yeah. So I hope that answered that person's question about how you use policies to pay for college. It's exactly what they did. And by the way, I'm starting up policies on my kids here soon too. Yeah. Yeah. I had to reach out to me. Yeah, send me an email. I can send you some of this stuff.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
All right, the next case study. Okay, so this is how a physician reduces tax burden and saves for retirement. This is kind of a cool one right here. Okay, yeah, done. Awesome. And then Carol, I can't really copy your email, so if you can send me an email, that'd be preferred, because then I can just respond back to you. James, where can you go to set up a policy? That's what I do. So I have hundreds upon hundreds of clients that I set up policies for. That's what I do. That's what we do here at BYOB. We set up policies for you. So I'll put in my call link here real quick, and then you can just schedule a call with me and I can walk you through the process, what it looks like. There's no cost or fees, nothing like that. Let's keep that in mind. Okay, so this is Dr. Andrea. Okay, so she's an orthopedic surgeon. I'm not quite sure exactly what that means, but she's in Texas. So a high income person. So typically what we see here is when you have high income, you also have high debt. You have high expenses. Doctors have told me that they are notorious for being bad with money. It's kind of weird they tell me that, but that's what they say. So 45 when she started, okay? Now her big concern is she was tired of paying massive taxes and relying solely on a volatile 401k for her future. So very concerned about the future, put money into a 401k, didn't really know what else to do, okay? Yeah, thank you, Sam, appreciate that. Yeah. Is there any way to get hurt, and what way is the risk? So Meryl says, I can answer that probably on a one-on-one call, but the only risk really is how you use the policy and making sure that you understand how to use it. And that's what we do. We teach you the knowledge on how to use it, because you've got to make sure you understand how it works, how it functions, that kind of stuff. But that's why we're here. That's why I'm doing this presentation, is to give you that knowledge. But yeah, the biggest risk is essentially the policy holder not using it correctly. But that's what we do. And so any of my clients, some are on this call right now, they can call me up whenever they want, and I'll help them use the policy correctly. Jim says, can I fund a policy for my self-directed IRA? Not without taking the money permanently out of the IRA first, because an IRA is a qualified plan under the control of the IRS. And so infinite banking is not. So it's a very different vehicle. But yes, there's a 10% penalty potentially, and the income tax potential. So yes, you can, but it has to come out permanently. So, all right. Yes. Yeah, exactly, Sam. Yeah, exactly. All right. So what was Andrea's problem? So Andrea's problem was that as a high income earner, she faced a few things. So one, paying 150 grand in taxes annually. That is a lot right there in taxes. The 401k plan, it's limited to $23,000 a year in contributions for her. So she couldn't put as much as she felt she should be putting into it a year. So that was a big challenge. Okay. Market volatility. So that could undermine her retirement. If the market changes all of a sudden, right, and the value goes down when she's trying to retire, all of a sudden she might not be able to retire because of that volatility. And she really wanted to protect her assets from that from the volatility and liability. But she wanted to create tax-free income because she's so sick and tired of paying taxes. She wanted to create tax-free income, which, by the way, you can do with infinite banking. All right. So what did she do? Well, actually, the problem first off. So this is the same thing. Oh, so the solution. So what she wants. So she wanted to, lower her taxable footprint. That's a big one. Safe compounding savings. Whoops. That's what she wanted to do. Okay. And she wanted it to be private and protected. Okay. That's really big what she wanted. She wanted privacy, and she wanted privacy from lawsuits and from government intrusion. So step one, 2 policies. So she did one on herself and one on her husband. Okay. Each one is at $75,000 a year for 5 years. So obviously high income people can do higher premiums. Keep that in mind. And so they're using after-tax dollars strategically diverted from overfunding brokerage accounts. So before this, more money was going into other vehicles. Okay, so they were overfunding all these accounts, but it was at risk. So they took that money from this bucket and put it to the infinite banking bucket. So high paid up addition ratios to maximize early cash value. So $150,000 per year, 120,000 was going towards cash value in that first year. Now, granted, as dividends come in, guess what? Year 5, they put in 150, but the cash value goes up by 160,000, more than they put into it. Policy gets very efficient. So that's what they did, step 1. All right, so next was cash value growth. By year 5, the total cash value was $630,000. Okay, so it had gone up by quite a bit. It's also growing. So you're earning dividends roughly 5.2%, compounding uninterrupted tax-free on the policy. Okay, so this thing is growing and growing and growing. And Todd, I'll answer your question here in just a second. I see it right there. Okay, so it's growing over time. So step 3, now what's the retirement look like? Okay, so starting at age 60, Andrew will be able to withdraw $80,000 to $100,000 a year tax-free as policy loans. And they can do this for a long time. And I'm going to show you exactly how long. The plan will fund income for 20 plus years without ever triggering a taxable event. So someone says, well, Brian, is $100,000 enough for them? Well, there's no taxes. So that's probably more like $130,000, $140,000 of income. But this is just, it's not their main source of income, by the way, in retirement. They have other things, okay? Because keep in mind, during the 5 years they're building this, what are they doing with the cash value? Well, they're making sure they have no debt. They're paying down debt, recapturing that. They're buying real estate, letting that pay back the policy loans. They're making the money work so they have more assets at the exact same time. But the cash value does not stop growing. So at 5 years down the road, age 60, they have other assets now that the policy funded, and they have the policy income. So it's not one or the other. It's all things working together. Okay. So what were the results? So tax advantage private pension. So think of it like that. They're not in the market anymore. So yes, they do have some assets still in the markets, of course, but they didn't pull them all out or anything. But they're not, this vehicle is not in that. It's a protected asset. So in most states, these kinds of policies are a protected asset from creditors and lawsuits, divorce, bankruptcies, things like that. In most states, by the way, if you're in California, get out. If you're in San Diego. So they're going to get retirement income, okay, tax-free for over 20 years. And guess what? As I said, optionally, they can access the funds for early real estate or travel if needed. So they have that fund. Florida is a protected state. Yes, Alicia. So it is protected there. So this is what it looks like. So for about 35 years, up until almost age 100, they can take out income tax-free from this policy. Okay. Now, if they started earlier, man, it would have been even better. Yeah. Yeah. So yeah, Anna, so you answered Todd's question right there. Yeah. It's Todd. So do you advocate this whole life insurance where there is no life insurance needed? Yes, Todd, it does depend on your situation. Because keep in mind, we're not focusing on the death benefit. No, we're not focusing on that. We're focusing on the living benefits. There is a bonus called the death benefit that is tax-free guaranteed. But yeah. And yes, I am a licensed agent in all 50 states. I'm also an investor, entrepreneur, all that kind of stuff. But yeah, I am. And we are a brokerage. Yeah. Yeah, Deb says, I'm in San Diego. You can still do policies there. It's just they don't have the same protection because it is California. Keep that in mind. Okay. Yeah. Yes, exactly, Deborah. Appreciate that. Yeah. Yeah. The great point there, Sam, too. Sam's been around, our campfire for a while. So the policy is just the vehicle. What you use it for and what you accomplish is the infinite banking concept. So it's just the vehicle. What you use it for is more important, in my opinion. Okay. All right. So this is another one. This is a really good one. So this is probably one of the, I don't want to say number one, but probably pretty close to the number one things that people use these policies for. And by the way, remember the equipment model example? We have software that shows you how to do it. If you're going to pay down debts or whatever, or invest into real estate, we have software that shows you how to use the policies effectively to do this. So you're not doing it blindly. I mean, we help you do all this stuff. Okay. So this one is how an average family uses IBC or infinite banking to eliminate consumer debt and take back control. Okay. So Chris and Jennifer, Phoenix, Arizona, 110,000 household income. Okay. That's a teacher and a firefighter. And so here's the debt. So before infinite banking, they had 2 car loans, about 32,000, around 6.5% interest. They had credit cards of around $18,000, 3 cards, by the way, and obviously high interest, 18 to 24%. And monthly payments going out to those debts was around 1,150 per month. Okay. And so that's money that is not going to them. That's interest not going to them. Once that money's out the door, it's gone forever. So the problem is they were stuck in that cycle. A lot of us have been there before. I've been there before, where we have these high monthly payments with little reduction in the debts themselves. Very hard to build up any savings because the cash is tied up in the debts. This couple, they felt like they were just working to stay afloat. I have a lot of clients that state that they're like, man, I'm just staying afloat. I'm not getting ahead, right? And so they wanted to pay off the debt without using savings because they had some savings, but they didn't really want to just liquidate that and just have it go out the window and not come back. But they also were losing money to the banks, and they knew this, and they wanted to build, something for the future while at the same time getting out of the hole. So if you guys understood what I just said, we want to get out of the hole, stop digging the hole, as they call it, throw the shovel away. But what about building for the future? Well, guess what? With infinite banking, you can do both. Okay. And so that's exactly what they wanted to do. Okay. So one, they went and got a policy because they heard about this, of course. And so they were going to start with 24,000 a year. That's 2,000 a month, by the way. Okay. And so it was a stretch for them. I'll be honest. It was a stretch. Okay. But what they did is they were just pummeling money into overfunding retirement savings and tax refund checks, right? All this kind of stuff. And so if you're drowning in debt, yet you've got money going into like a savings vehicle or a retirement vehicle, maybe it might make sense, and this is not financial advice, by the way, to take that money temporarily away from the retirement vehicle and get rid of the debt, because that allows you to build wealth faster when you have no debts. Then by all means, go back into the retirement vehicle. Okay. But that's what they did. They redirected the funds into a policy that was going over here originally. And then over the next 2 years, they built up a $36,000 cash value inside the policy. Okay. Now, what they do, the next thing they did was in year 3, they took a loan out. And by the way, I mean, the way that we would actually have you do it is actually you'd be paying off the loans, the credit cards every month. You'd be moving money out of the policy into it, but I want to keep it simple. So they paid off the credit cards and the car loans. Okay. Now, how we show you to do it with our software is you do it monthly or quarterly, not annually, but regardless. So then what they did is they repurposed the $1,150 going to the debts, and they put it back into their policy loans. Okay. Okay. And so then they also had some additional income because guess what? I don't know who, but they got like a small raise, something like that. So they put in an additional $200 to accelerate the debt payoff. Okay. So here's the results. The loan repayment scheduled for over 3 years. Okay. So that's what it was. It was for 3 years about. They used the same dollars that they were already sending to the banks. Okay. It's going out, and now put it back into their own family banking system. Additionally, and by the way they did it, I believe they had 2 policies on each other. So they were both covered. Both incomes were covered. Okay. So in case something happened prematurely to one of them, their income would be covered by the death benefit. Okay. But the interesting thing is that they maintained that flexibility. So if there was a tight month, they could adjust the payments back to their own policy. They could take it down to 0 if they want. It doesn't really matter. It's whatever you want. Okay. So they're able to adjust it. So what were the results after 5 years now? Okay. So after 5 years, they eliminated over 12,000 of interest payments to the debtors, the credit card companies. Okay. They paid the debt off 3 years faster than scheduled. So they paid it off a lot faster, which is typically what happens. They built around 40,000+ in cash value while becoming debt free. Okay. Yeah. So not only did they pay the debts off faster and quicker, they also have wealth and value after the fact that they can now put to work. Okay. So what they're looking to do now, I don't know if they did it because I haven't, we haven't talked to them since then, but they were going to use that as a down payment on a rental property to start building assets. Okay. Now they're kind of flipping the switch to, instead of paying debts, they've recaptured the debts, and now they're going to start building wealth, building assets. Okay. So, and how they do that. So really how they did that is they had to change the way they think about money. That's really what had to happen first. They had to change their mindset around money. Okay. We're taught to use debt, right? But they changed and then here's the results. Okay. So obviously the traditional way is on the left-hand side. IBC or infinite banking is on the right-hand side. And so you can see how much interest down below they saved or would have paid, right? So, I mean, they would have paid a lot if they had just done it traditionally, okay? So infinite bank, and this is, by the way, just the debts, not paying the loan back. But yeah, it would have been 60 months originally. And with infinite banking, it was, 2.25 to recapture, to recapture those debts, okay? And so and by the way, the other thing to keep in mind, when they paid off the credit cards and the car loans, what happened to the debts on their credit report? They vanished. They moved them into their policy loan. They still had the policy loan debt, but the policy loans are not on your credit report. So all of a sudden their credit went up because they had those debts paid off, and their loan ability, if they want to go get like a mortgage for a second property, maybe a rental property, something like that, which is what they're doing, by the way, they can qualify more easily for a mortgage or a HELOC on their main home. So it has a lot of benefits. So yeah. All right. So make sure I have any questions. So once again, if you guys want to, schedule a call with me, I'll put my link inside there. And if you want to email me for anything, I recommend you email me, because I might not be able to grab your emails, because I see some people have put their emails in. I might not be able to grab them. So go ahead and just send me an email. My email's right there, brian@chrisnaugle.com. And then I can, send you whatever you need, any links, any information. Okay. All right. So the next case study is Amanda, and this is a real estate investor who was doing lots of deals, and she was using hard money lenders. So if you've ever done real estate flips and things like that, you use what are called hard money lenders that lend out like at 12%, 15%. They're, short-term loans. By the way, that's also how Private Money Club that we talked about with when Shane was on. Private Money Club is basically hard money lending as well. So Amanda was a full-time real estate investor doing fix and flips and rentals. Deal size around 80 to 150,000 per property. I wish I knew where that was. Well, no, she's in Charlotte. Okay, that's why. So where I live, it'd be like 3 times that. That'd be awesome to do deals of that size. Longtime student of us and of Chris's. Okay. So she was doing about 3 to 4 flips a year, but faced a lot of challenges. And this is something that I've been involved with before. They had to rely upon hard money lenders, 10 to 12%, 2 to 3 points. So that's kind of your origination fees. They wanted to close quickly, and if they didn't use hard money lenders, the only other option was a traditional bank, which would be cheaper interest, but they take a long time, 30 to 60 days to do a traditional mortgage, where hard money lenders are about 1 to 2 days in most cases. So the profits were being eaten up by a lot of the financing fees. Okay, so it costs a lot to maintain these loans. If your project goes longer than expected, it just keeps eating into your profits, essentially, right? And she had no system to recapture or recycle her capital efficiently from one deal to the next. Okay, so very common problems when doing real estate. Someone says, "Do you guys flip homes?" Well, like Carson does. I've done it before. I mean, we don't, as a business, we don't do that. We just do infinite banking, but individually, yes. Yeah. So Marisol just said, just paid 43,000 to pay a hard money lender just to do a 560K loan. Yes, they're they can be very expensive, can't they? Yeah, definitely. Yeah, so William, so it's brian@chrisnaugle.com. I put it in the chat box, if you can see that there. So I'll put it here as well. There you go. All right. So what did Amanda do? Okay. So she, sorry, by the way. So what she wanted was, fast access. She wanted to be her own funding source. That's what most real estate investors eventually want to be their own funding source, but also wanted to compound wealth and while being active in real estate. And so every time she would use cash, it ties up the cash. So she was very limited. So what did she do? So obviously infinite banking, she was able to do this with $50,000 a year. So what she would do is she would take some of her capital from her projects and she would set it aside for, oh yeah, Chris Naugle's texting me right now. He's asking me if I'm in the presentation. Yep. Yeah, so she was doing 50,000 a year in premiums. So the structure was about 70% to PUAs. So she was optimizing early cash value growth, getting it going quickly. And after 3 years, she had 115,000 in available cash value approximately. So she was doing some larger dump-ins, so a very, very efficient policy. And so what she was doing now, by funding the policy, she was taking out funds to do her hard money lending to herself. Okay. So now she was funding flips. So like as an example, this is one that rough numbers that she provided, $80,000 purchase price, rehab of $20,000. So she was not only funding the purchase, the acquisition, but also the construction cost. Okay. Closed in 10 days, no bank underwriting because she was the bank, right? No red tape. And she sold it 5 months later for $165,000 approximately $50,000 in profit. Okay. So what she did is when she had the loan outstanding, that $100,000, she did not pay the loan back. She didn't pay it monthly. She waited till she was done with the project and then paid the full loan back. And she paid it back. I mean, it wasn't fully $105,000. It was like 103,000, but just for general numbers, it was about 105. And then just did the same thing right away. So she paid the $100,000 right back, but guess what? She could take it right back out again. So, and she didn't lose any growth by doing that. So the money can go in and out just like that. Okay. No waiting period. And she's repeating this like about 3 times a year, about 3 times a year. Yeah. Yeah. Sam said, yeah, be your own money lender for your company. Yep, exactly. And then Marisol says, beware when you transfer from one company to another, it could be taxable to you, structure important. Yeah. Yeah. There's all that kind of stuff you got to be very aware of, depending on what you're doing for sure. Now, does your company help to flip homes? No, we don't really help to flip homes. I mean, we're a private money club. You can actually go there to get financing potentially for a home flip. Yes. So that's one way we kind of do get involved in it, but currently, no, we don't really help you flip homes. So the results, so she avoided a $9,000 to $12,000 in hard money cost per deal. Now, here's the thing though, guess what she can do though? So she could have an entity that lends to her project, and that entity could actually charge the project the same rate as a hard money lender. And now you're paying your entity back from the real estate project at 12%. And then you have another entity that's creating more income, more capital, more profits. So there's lots of ways to do this, by the way, but yeah, this is kind of generally speaking, but yeah, 100% equity and profits, of course, love that. Still earning dividends on the full amount that she borrowed. And now she's her own private money lending system, and she wants to expand with, a second policy for larger projects. So yeah, so definitely doing more projects, but this is essentially what it looks like. So with hard money, you can see what it would look like profit-wise on the left-hand side versus the infinite banking profit on the right-hand side. And so you can see down below, the cost per deal with the hard money is 8,000. With infinite banking, it is actually about 2,000. Now, granted, did she fund the policy first? Yes. So keep that in mind. She capitalized the policy first. You don't build wealth overnight unless you get lucky, right? So she did fund it first, and her profits went up by quite a bit because of that right there. Yeah, yeah, yeah. There you go. That's funny. And then Lexi said, yeah, you can do it under a trust. Yes, you can. Yeah, you can use. Yeah, a lot of our clients, by the way, do use trusts and have the trust own the policies, which you can do, by the way. Kind of more of a privacy strategy. Okay, so I just responded to that one. Yeah. Yeah, then Anna says, if you don't pay it back, you would only need to pay the interest on a yearly basis. So yeah, so you don't even have to pay the interest, by the way. You don't even have to pay the interest. Now, we recommend that you do at a minimum pay the interest, but if you're having your money go from one deal to another, to another, to another, you don't have to pay the loan back. You can just pay the interest, because if it's only going to be like, sitting in your bank account for say 2 weeks, you don't need to dump it into your policy and then take it right back out again. You can just keep it rolling. Absolutely. Yeah. And Marisol, so you drop 100 first before you fund? Well, you can drop $100,000 into a policy. Your premiums would have to support that, but that's what I would walk you through. But yeah, you can do that. I mean, a lot of our clients are doing that. They're dropping a large amount in up front, in addition to the maybe smaller premium, in order to borrow right out within 30 days. Yeah. The loans are not taxable. Correct. Yeah, exactly. Ida says, how can infinite banking be used to avoid the cost of tariffs? It all depends on how you're incurring more cost because of tariffs. Don, so we don't personally set up trust, but we have a trusted partner that does it with our clients. I work with them, they're working with me, that kind of stuff. But yeah, we do have somebody that we use that understands infinite banking. So to do a trust, yeah, Brent Carl, there's Anne just said right there. That's awesome. But yeah, so you got to have somebody who understands infinite banking. I recommend that for when it comes to setting up a trust. Okay. All right. So this next case study is a bit different. Okay. So this is actually a real case study. Carson, one of our mentors like myself, one of my colleagues, shared the story with me here yesterday. So let me get to the next page. Okay. So this is Dan. So Dan, no kids, not married, average 9 to 5 guy, trading time for money, kind of paycheck to paycheck. I felt like he was not getting anywhere. Early 50s, by the way, as I said, and he wanted to pay down some debt and then maybe start investing. That's really what he wanted to do. Okay. That was his goal and his focus. And so we did a policy. I think it was about $600 per month. I think Carson said had about a $400,000, I think, death benefit, something like that right off the bat. Excuse me. And he started to recapture debt. And then this is kind of fun. So this guy, so we knew this gentleman. I didn't know him personally, but Carson did. he went to a lot of our money multiplier events, our BYOB events. So we had seen him before. Okay. But this is what happened. So he had some crazy heart disease that popped out of nowhere, and he unfortunately passed away. Okay. So he passed away in his early 50s. So that happened. Herbert says, what kind of whole life do we need? Well, I would walk you through what that is. Oh, yeah. So you only need about 30 minutes. Yeah, it's a specially designed permanent whole life policy with a mutual insurance company. So I'll put in my links here in a little bit so that you can watch the video that talks through what it is. But yeah, so he passed away, and this was one of our clients. And in this kind of business, and we've had to deliver these kind of things many times. It's called delivering the death benefit. Okay, yeah. So this is what happened. So his sister was the beneficiary. Okay, so he didn't have any kids, didn't have a wife. The death benefit had grown over the last year and a half to about $500,000. It was paid out to her tax-free, guaranteed. Okay, so the death benefit is tax-free, guaranteed, and you can see it grew. They grow over time, so it's not like a stagnant number. They grow over time. The family was able to pay off all of Dan's debts. Yeah, Marisol, yeah, he passed away, unfortunately, and so we've had this happen to many clients. It happens, but fortunately, he had the policy, so his sister got the benefit. They paid off all of his debts. And they also paid off the debts of two other families. So her family, and then I think it was maybe his brother's family. So they paid off all the debts of the rest of the family. So the family had no more debts, and then created an emergency fund and college fund for his sister. Okay. So why do I bring this one up? Death happens, right? And it's a very unfortunate thing, but we're all going to die. That's the thing, right? We're going to live, we're going to die. We know that. Infinite banking, the whole life policies, the benefits are the death benefit is tax-free and guaranteed. Okay. And it goes up over time. So Dan, he put in, I don't know what, gosh, $12 or $15,000, yet it paid out $500,000. So if you understand what I just said, if you do this on yourself or on your kids, that money is going to grow over time. The death benefit is going to grow over time. It's going to be worth, for the next generation or whomever is the beneficiary, it's going to be worth 3 to sometimes 10 times what you put into it. 10 times. Now, this has been around for hundreds, over 150 plus years. Been around for a long time. Okay. Wealthy families have been doing this for generations, so we know how it works. We've seen it. You can go look it up. It's crazy, but this is an example of it. And so I want to share this one case study because even though it's not a positive one, there is a positive light to it. It's we call it the light in the darkness. Okay. Yes, his family would like to have him back, but they're also grateful that he had this in place because it had a massive impact. In fact, his sister called up Carson, almost in tears, about how grateful she was that he had done this. So, I always tell people, it says, if you care about the next generation or those around you, your loved ones, this is a phenomenal concept because it doesn't just do that, it does everything, right? Okay. Yeah, Lucy. Yeah, hopefully they start. Yeah, exactly. So Lucy is one of our clients as well, and she has policies on grandkids and things like that. And yeah, I hope that they learned the lesson from Dan and started up their own policies. Okay. Yeah. So yeah, absolutely. Yeah, and everybody. Yeah, I wish I knew this in my 20s. Yeah. Yeah. So Sam said he did some calculations, and if he had done this 30 years earlier, he'd be a millionaire by now. Now, granted, Sam, some of the stuff that we do now wouldn't have been available back then, but yeah, you're right. It's insane what this can do over time. Yeah, especially on kids. Okay. So yeah, 20 years. There you go, Sam. All right. So this is another way that some people have used this, and it's called a buy-sell agreement. So these are some business partners, Jeff and Alan, and they have a law firm down in Nashville, Tennessee. I love Nashville, by the way. I've been there many times. Their firm, the value of the firm is around 2.5 million. And they're in their early 50s and late 40s when they did this, and so they're 50-50 partners in the business. Okay, so 50-50. And the problem, so they wanted to protect the business in case one of them passed away or became disabled, that kind of stuff, because that can happen, right? And so high business valuation, but no liquidity. So if you have a business and you own 50% of it, and something happens to your partner, but there's no liquidity, what do? How's the family buy you out? How do you buy the family out, right? How does that work? So that's the concern. So how does the surviving partner buy out the deceased partner's spouses or heirs or estate, right? How do they buy them out? So banks can offer you life insurance backed loans, but that would just add debt at the worst time, by the way. So that's not, I don't really have any experience with that. So attorneys, okay? They have they're attorneys, that's what they are, but they have no clear succession mechanism. So, and even though they are attorneys, kind of funny, okay? So their goal was to create a self-funded, contractually enforceable, what's called a buy-sell agreement, and then keep control of the firm in the hands of the survivor. That's a big thing that happens, is the survivor might lose control and have to sell out the business at a fire sale, they call it. And then avoid debt or a forced asset liquidation, like I just said right there, so they can be forced out of it. Okay, so here's what they did. So they got policies on each other, okay? And their whole life policies. Policy face values is around 1.25 each, okay? That's that 50% valuation of the business. The premiums are about 18,000 per year funded through business. So the business is funding the policies, which makes sense. And these are designed for early cash value, but long-term protection. So this is a long-term concept too, by the way. So here's what they did. They have agreements with each other. So the firm owned the policies, and also the firm is the beneficiary. Okay, so you can do this. Okay, an entity can be the owner. And then they have a buy-sell agreement that's between the two of them that legally binds them. So if something happens, it would come into play. If one partner dies, the policy pays out, then the firm would use that death benefit, which is tax-free, guaranteed, to buy out the deceased partner's share from the estate. Okay. So then the surviving partner would retain full control of the business. Okay. So that's how it can work. But here's the thing. They've also got cash value building inside the policies at the exact same time. Okay. They say it's growing. And by the way, when you're doing a business owning the policy, it's actually can be a taxable event down the road. So it's get tax deferred instead of tax free. And then what they'll use the loans for in the policies is 10 years down the road to help fund retirement buyouts or transition equity to junior partners. So they're going to use the cash value to do a buyout down the road. So they're funding so here's what they're doing. They're making sure that if something happens prematurely, they're covered. They're also funding retirement buyouts or funding the transition to a future partner, all at the exact same time. It's amazing, by the way. So we call this a fully funded buy-sell plan, but they're not borrowing or tying up capital because they still have access to the cash value if they need it, by the way. If they agree to, hey, we want to borrow from the policies to maybe expand the business, they can do that at the same time. Okay. Peace of mind from from taking care of the other partner if something happens, maintaining control, cash value, continues to grow. So that provides liquidity. So if they need to use the cash value for something, they can have access to it, and they have that succession plan. Okay. So if you look at a traditional buy-sell strategy, it's not liquid. There is no tax-free death benefit, right? It impacts your cash value of the business. The traditional one, does require a buyback for a bank loan, by the way. You don't have control over it. So you don't have control over a traditional one. You can use it for other things like retirement. Whereas if you're doing a traditional buy-sell, you can't do that. I mean, you can if you're using savings, I guess you can use it for that. And hopefully it's growing for you. But then of course the business, these policies are protected. What if the business gets sued? Okay. So many cool things this thing does right there. So this is a cool one right there. Doesn't come up a lot of times for clients, but I wanted to share it here just so you guys are aware that this is possible. Marisol, yes, age does matter. So at 77 years old, you can't really do this, to be honest. It does get more challenging. My oldest client is 74. I believe it's 74. Yeah, Lucy got her, 61. Yeah. So I mean, up to age about 71 to 74 is kind of the limit, but they can always own a policy on somebody else. So your dad can own a policy on you, and he can fund it and be in control of it. So there's lots of ways this can work. Yeah. So there's lots of ways to do it. All right. So this next one, this one's kind of doesn't hit close to home, but it's pretty important to me. So this is how one of our clients, she wanted to use infinite banking to build wealth and teach her kids about money. Okay. And so she wanted to pass that knowledge on, not just money, but knowledge. So Melissa from Sacramento, she's a nurse practitioner, single mother, by the way, 130,000 per year, 3 kids, ages 8, 12, and 14. And so she wanted to transfer the money to them in a responsible way. She wanted to avoid the money sitting in her savings because she had it in her savings account. Didn't really like that because it was in the bank's control, banks making money off of her money, etc. She wanted to teach her children about financial responsibility, about cash flow, entrepreneurship, that kind of stuff. And then she wanted to leave something behind that, not just a will. And by the way, I do recommend you check out a trust with your will inside the trust, by the way. But she didn't know how to do that. Okay, so legally, financially, didn't know how to structure it. She wanted to keep control of whatever this was as a parent, but then also give it to her kids so the kids could start to access it. and then protect the money from taxes, from lawsuits, and from poor decisions. What are poor decisions? Okay. It's what a lot of us make when we're younger, by the way. So she wanted to do that. Okay, so she wanted to do 3 policies. And so she was setting aside money for her kids. So about 10,000 per year for each kid. She was setting that aside for things like college, stuff like that. So she said, hey, you know what? I'm going to go put this money into a policy. Marisol, yes, health can make a difference. It depends on how you're disabled and why you're disabled. But yes, health is one of the ways you have to qualify for life insurance. Yeah. So we did a high PUA contribution, so maximize the early growth of the policies. And then her goal was to be the owner of these policies on her kids day one, and then give control of the policy to them when they turn 25. And so the cash value by year 3 was able to be used. So for her son, 14, used it to start a pressure washing business. So he borrowed a bit of money out of his policy to set up a pressure washing business. Went and bought the equipment, bought I think a trailer or something like that, right? Her daughter was able to use it for buying a car. I think that's what her plan was. And then had the daughter and the son too, by the way, repay the loans back from the business and from her part-time job. So they're teaching them about borrowing money from yourself and paying it back responsibly. And then for her youngest one, I think it was, well, actually all the kids, I think, covering private tutoring and summer programs, and then having them pay those back with their part-time jobs, part-time incomes, essentially paying themselves. Okay. Yeah, Sam. Yeah, definitely. Yeah. Yeah, James. Awesome. Good you set that up. Okay, so here's what it is. So at age 35 or 25, here's the plan. So each kid's going to receive ownership of the policy. Okay, going to get ownership of the policy. It'll have roughly $50,000 to $75,000, depending on the age of the kids when it starts, at that point in time. And she's also realized, and the kids are going to realize this as they learn more about this, that they can use this policy for doing things like a down payment, like maybe on a home, something like that, an emergency fund. If they want to go start their own business, go use it for that. And then they can also use it for retirement, because if they keep funding this one and do more policies, they're going to have multiple 6-figure tax-free retirement down the road, which, I mean, can you imagine if you have something like this that's building for you at that age, knowing that you're going to have retirement down the road, but you can use this thing to do other things in your life? It kind of changes the way you think about trading time for money, doesn't it? If you're, 18, 21 years old, looking at the prospect of a career, you can use this thing to do real estate investing, start your own business. I mean, it's just incredible. So, I mean, it's amazing. I mean, so 3 legacy policies that are tax-free, right? I call them legacy policies because these policies will eventually do generational wealth for the kids' kids. So her grandkids are going to receive the benefit of this down the road. She's teaching her kids how to use leverage responsibly. That is a big thing right there. It's not locked up in UTMA and UGMA accounts, which are age-based. She has full control until the kids are, mature enough to take it over. And she doesn't have to give it to them at 25. She can wait till they actually prove themselves they're responsible enough. And then she's managing or not managing, but multiplying the family wealth without any high risk investments, things like that, right? So what are UTMA? So I'm not going to go through all this kind of stuff, but there are other things that you can use to put money aside for kids. So, but they have tax issues, things like that. But this essentially is what the cash value looks like for the youngest one, from I think age 1 to like age 17. I mean, the cash, the amount in this policy is going to be very high over time potentially. So yeah, pretty cool. Yeah, exactly. It's pretty cool, isn't it, Lucy? And then Victoria, what is the minimum amount to dump in? So for kids, dump-ins are hard on kids because of the age. So yeah, and you don't have to do dump-ins, by the way. Yeah, you don't have to do those. And on kids, it is a little bit challenging. But yeah, you could do $2,000 per kid and have them contribute to funding. Yeah, absolutely, Victoria. You could do that. Yeah. I mean, the minimum is for a juvenile, if they're under 18, is about $100 per month. That's the minimum to do them on kids. So if you have kids or grandkids, $100 per month, go for it. I definitely recommend checking it out, because just get the ball rolling. A snowball, right, will get bigger and bigger as it goes downhill. So same with these. Okay. All right. We're at the 30 mark. Let me go through this last one pretty quick. So this is how a family used it to recapture cars and interest. So this is Kevin and Lisa in Austin, 160K, family of 5, 3 cars over 10 years would be needed. Okay. All right. So what they do? So Kevin, or I think it's Kevin, and already both of them had already done like $70,000 in loan interest on autos over 15 years, because they would always buy new cars every 3 years. No assets to show for it. They paid a bunch out, but they have nothing to show for it. And so they realized after they saw one of our presentations, this is ridiculous. Stop doing this, gain control back. So they did it through, they saw it through one of our podcasts. Okay. So they did one policy on Kevin at 25K a year, high PUAs. And then they built about 70K in cash value by about 4 years. They did that. Okay. And it probably would be a bit more than that, but I'm just using round numbers. So they took a 30K loan out in year 4 to buy a used SUV for Lisa. Okay. Then they paid themselves back like they would, or actually like they were doing with the traditional bank, right? So they paid it back to their own bank. Year 6, another $35,000 loan to replace Kevin's sedan, paid that one back, same as they would otherwise at $700 per month. Year 9, bought their daughter, who was now old enough to drive, I guess, her first car with a 15K loan. Guess I got her a pretty used car right there. And then she repaid it back from her part-time job to learn how this whole thing worked. Okay. And so they treated each policy just like a private car loan, just like a regular car loan. They treated this the same way. All repayments built the policy cash value back up again while keeping the money in the family's control. No credit checks, no banks, no restrictions. Absolutely amazing. And they are in full control. And guess who owns the cars? They have the title, not the car loan company, not the bank. They have the title. So that saved them around $32,000 of interest payments to the car finance companies. They could reuse the same money 3 times. Okay. They retained full ownership of all the vehicles. They built an appreciating asset, which is the policy, while financing depreciating assets. That's kind of the cool thing right there. So these are depreciating assets, and they taught their daughter how this works. Okay. So guess what? Whoops, same slide right there. Yeah, same slide. So they taught their daughter how to do this. And guess what? They can do this now for the rest of their lives. They can do it on their other kids when they become of age to drive as well. So they kept that in full control. So guys, that was the last case study right there that I had for you guys. Gosh, right on time, just about. So Marisol says, so if you were to pay off all your debt with this program, let's say $3.5 million, and pay back the interest to the policy, can we write off the interest paid to the policy back? That's a great question. So it depends on how you structure it. So you got to have agreements, and you got to go through a tax person to set it up correctly, but potentially yes, because if you take the money out and put it through an entity or through an LLC, the interest rates are an expense to the business. So there are ways to do that. Yeah, this has been great. Okay, yeah. These are pretty cool. And Max said, what type of policy was the one you used for the kids? So it's a whole life policy. So it's a permanent whole life policy. Excuse me, but it's so we work with multiple companies. And so it depends on which company you use and what product you use at the insurance company. And so we just, I would have to talk through the scenario and what you're trying to accomplish and make sure that we use the best company for the kids. So it just depends. Yeah. Yeah. I mean, Marcel, yeah. So there's financial people I'd recommend you go talk to about it that we know. I definitely recommend that you check them out. So yeah. But yeah, there's lots of ways to do it. But once again, though, the biggest thing here is that you're the one in control of the loan. It's like there is no bank that's going to tell you got to make a payment of this much per month. That does not exist with this, because you are the one, basically in full control. I'll put my call link in the chat box and my email one more time. So yeah, if you guys have any questions about this, obviously feel free to email me. If you guys want to schedule a call with me, grab that link right there. And then also there is a video that we do have, and you can send me an email if you want. I can send you a link to it. Or if you click the call link and schedule a call, you'll get a link to that as well. But yeah, there's a 60-minute, 90-minute video that we do recommend you check out that does go through infinite banking in a bit more detail than what I did here. This was mainly to show you what people use it for, okay, or what our clients have done with it. So, all right, everybody, appreciate all of you. Thank you so much for all the comments, the responses, and I love seeing familiar names. Kathleen, I just saw that your approval came through, and I saw your email come through, so I'm pretty excited about you getting that thing rolling. So it's gonna be awesome. All right. Oh, Marisol, yeah, great. Glad you got an appointment. That's awesome. I look forward to talking to you as well. Yeah, and thanks, Crystal. Everybody, take care and have a good day, everybody. Bye.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.